Bonds have long been considered a safe haven for investors, providing steady income and stability in portfolios. But in today's low-interest rate environment, traditional bonds barely keep up with inflation, leaving many investors questioning their value. Are bonds dead, or is there still a way to make them work for you? The truth is, bonds are not obsolete. They just require a smarter approach. Blindly holding government or corporate bonds may no longer deliver the returns you expect. Investors need to rethink strategies to protect wealth, generate income, and balance risk. Today, we'll break down why bonds face challenges, where opportunities still exist, and how to adapt your portfolio for a low-rate world. By the end of this video, you'll know whether to hold, shift, or diversify your bond investments for maximum efficiency. 1. Why bonds are struggling. Traditional bonds face a tough environment because interest rates are historically low. When rates fall, bond yields decline, reducing income for investors. Inflation further erodes purchasing power, meaning a bond paying 2% may effectively lose money if inflation is higher. Many investors relied on bonds to provide predictable income and stability, but now those expectations need adjustment. Long-term bond prices can also fluctuate significantly with rate changes, adding risk many aren't prepared for. Retirees and conservative investors feel the impact the most, as low yields make it harder to generate living income. Understanding the current challenges is the first step toward rethinking fixed income strategies. Bonds are still a critical part of portfolio risk management, but they require careful selection. 2. The role of bonds in a portfolio. Even in a low-rate world, bonds serve several important purposes. They reduce portfolio volatility, act as a hedge against equity market swings, and provide liquidity when you need cash. Bonds historically balance the risk of stocks, helping investors sleep better at night during market downturns. They also allow investors to strategically plan for income and future obligations. However, blindly buying traditional bonds without considering interest rates can backfire. Investors must focus on the role bonds play, not just the nominal return. Using bonds strategically can still protect capital while providing flexibility. They remain an essential tool for asset allocation, risk management, and diversification. Properly selected bonds continue to support long-term financial goals, even when rates are low. 3. Risks of holding. Traditional bonds' low interest rates bring several hidden risks for bond investors. First, the income may not keep up with inflation, eroding real returns. Second, long-duration bonds are highly sensitive to rate increases, meaning prices can fall sharply if rates rise. Third, credit risk exists for corporate bonds where companies may default or reduce payments in difficult economic times. Many investors underestimate these risks, assuming bonds are always safe. Even government bonds are not completely immune to market fluctuations and geopolitical events. Ignoring these risks can lead to losses that offset perceived safety. Understanding both income and price risk is crucial before adding bonds to a low-rate portfolio. Diversification within bonds can mitigate these threats. 4. Alternatives to traditional bonds. Not all fixed income options are created equal. In a low-rate environment, investors can explore alternatives such as short-term bonds, bond ETFs, inflation-protected securities, and dividend-paying stocks. Floating-rate bonds and corporate credit bonds often offer higher yields than government treasury. Real estate investment trusts, preferred stocks, and income-focused ETFs can also supplement income. Even peer-to-peer lending or high-quality municipal bonds may provide better returns for certain investors. Diversifying across different fixed income instruments spreads risk while enhancing potential income. The goal is to generate predictable cash flow while managing volatility. By looking beyond standard 10-year government bonds, investors can reclaim some of the lost yield. Combining multiple income sources ensures a more resilient portfolio. 5. Tactics for maximizing bond income. Investors can take several tactical approaches to boost returns in a low-rate world. Laddering bonds of different maturities reduces reinvestment risk and allows access to higher yield opportunities over time. Shortening duration reduces sensitivity to interest rate changes. Actively managing a bond portfolio rather than buying and holding blindly can uncover hidden opportunities. Combining bonds with other income-generating assets can supplement low yields and create a balanced portfolio. Investors should also consider tax-advantaged accounts to maximize after-tax income. Monitoring credit quality and interest rate trends ensures better decision-making. Strategic bond allocation allows investors to maintain income and stability despite challenging conditions. Understanding these tactics helps investors extract the most value from their fixed income holdings. 6. Bonds versus stocks in a low-rate environment. Stocks often outperform bonds over the long term, especially when bond yields are low. Dividend-paying equities can provide higher income than many bonds while offering growth potential. However, stocks carry more risk, and equity downturns can be steep. The right balance between stocks and bonds protects against market swings while providing reasonable income. Low-rate bonds alone may not support retirement income goals, highlighting the need for diversified strategies. Combining stable dividend stocks with bond alternatives can improve overall portfolio efficiency. Asset allocation and risk tolerance should guide how much of each to hold. In many cases, a hybrid approach offers better returns with manageable risk. The key is not abandoning bonds, but integrating them strategically with equities and other income assets. 7. Long-term outlook for bonds. Interest rates will not stay low forever. Economic cycles, central bank policies, and inflation expectations will influence yields in the future. Bonds may regain value, and long-term investors could benefit from holding selected bonds now at low rates to capture future upside. Being patient and flexible allows investors to adapt to rate changes while managing portfolio risk. Even if current yields are disappointing, bonds remain a cornerstone for diversification and risk management. Holding a mix of short-term and high-quality bonds can provide flexibility and liquidity. Investors who understand interest rate trends and portfolio positioning will benefit in the long run. Ignoring bonds entirely may expose portfolios to unnecessary volatility. The long-term perspective ensures bonds continue to serve a purpose, even in challenging environments. 8. How to build a low-rate bond strategy. Start by assessing your income needs, risk tolerance, and investment horizon. Focus on quality over quantity, diversifying across issuers, maturities, and sectors. Consider alternatives like short-term bonds, inflation-protected securities, and dividend-paying equity. Monitor your portfolio regularly and rebalance as market conditions change. Incorporating bonds strategically ensures stability while pursuing growth. Layering different bond types creates flexibility in low-rate environments. Align your bond strategy with overall financial goals, including retirement, emergency funds, and cash flow need. A thoughtful approach ensures bonds remain a valuable part of a resilient investment portfolio. If this video helped you understand how bonds work in a low-interest rate world, take action now. Review your portfolio to identify where traditional bonds may underperform. Explore alternatives like short-term bonds, dividend stocks, and inflation-protected securities. Diversify and rebalance to maintain income and stability despite low yields. Share this video with someone rethinking their bond strategy. Subscribe for more actionable investing insights, and hit like to support content that empowers smarter decisions. Taking control of your bond allocations today ensures long-term financial security and portfolio resilience. Don't wait. Adapt your strategy now to protect income, reduce risk, and maximize returns over the long term.